If you stay, I'll show you the easiest way to kickstart your day trading journey, even if you're a total beginner. Day trading starts with market structure. You open a candlestick chart, you zoom out, and start reading. A successful day trader must learn to ride market trends, figuring out who's running the show in the market, buyers or sellers. This is the first big secret to successful day trading, finding trades in the direction of the dominant trend. An uptrend is like a staircase, with each new high stepping above the previous one. As long as the lows keep respecting the previous lows, the buyers remain in control. When the price takes a dive below a previous low, that's a shift in market structure, a sign that the sellers might be taking over. A downtrend is like a slide, with each new low slipping below the last. The sellers keep the pressure on, as long as the highs can't reach the previous high. But when the price finally breaks above a previous high, it's a sign that the buyers might take control. Again, that's a shift in market structure. Sometimes, the market takes a break from trending. This is when the price gets stuck in a sideways range, bouncing between supply and demand. We call this a consolidation. Now, trend trading is the perfect strategy for beginners. The simplicity of following the dominant trend is precisely what makes it so powerful, especially for newbies. If your market is trending, day trading pullbacks is your best choice. If it's a trading range day, you'll enter at the extremes of the range and stay out of the middle because it can be very choppy. Even safer is to trade ranges that align with the previous trend. So if you spot a consolidation after a previous uptrend, it's better to trade only the lower side of the range, looking for buy signals only. You're still trend trading, but during range-bound conditions. In order to correctly read the market, you must rely on price action and candlestick analysis. Learn to read market momentum using candlesticks, and you'll be one step ahead of most traders. It's simple. The body of the candlestick shows the opening and closing prices. The wicks show the highest and lowest prices reached during that period. Bullish candlesticks are those where the closing price is higher than the opening price. Bearish ones are those with the closing price lower than the opening price. During trending days, it's all about price momentum and follow-ups. When the market is in a strong uptrend, you'll see a series of bullish trend candles with decent-sized bodies and high closing prices. The bars slowly ascend, creating a parabolic curve that makes you wish you had entered earlier. And any pullback attempts are short-lived, with narrow bearish bars having wicks at the bottom. The key is to look for more bullish bars than bearish ones, both in quality and quantity. If you witness these conditions and market structure confirms the trend, look for buy opportunities. In a strong downtrend, you'll see consecutive bearish bars with average-sized bodies and wicks on top. Bullish pullback bars are small and short-lived. The close of each candle is lower than the previous one. Again, you'll look to sell pullbacks if the market structure confirms the trend. Another way to identify trends is by monitoring highs and lows of the individual candlesticks. In an uptrend, each follow-up bullish bar should have a higher high, a higher low, and higher close than the previous one. For downtrends, bearish bars should make lower lows, lower highs, and lower closes. Again, when the market is trending, pullbacks are your best choice. You want to align your trades with the prevailing market sentiment. Range days are harder to day trade. Ranges are essentially consolidation phases. To read a price action range, you first need to analyze wicks. Ranges are filled with wicks, especially at the top and bottom of the range. These wicks represent failed attempts by buyers and sellers to push the price beyond the boundaries. You'll also notice an alternation between bullish and bearish strength. In a range, both sides are active, but there is no consistency or continuation. Bullish and bearish bars are roughly equal in quantity, and any strength is short-lived. You'll also see many doji candles and overlapping price action. Doji candles indicate indecisiveness. Overlapping bars, where the size of the bars are similar or inside each other, also suggest sideways movement. When you day trade ranges, you always enter at the extremes of the range, not in the middle. Look to buy the lower channel of the range during uptrends and sell the upper channel of the range during downtrends. Market structure and candlestick analysis go hand in hand with supply and demand. You see, when you day trade, you don't have the ability to influence the market. It's the big players that really move the market. They're the ones with the buying and selling power to create imbalances in supply and demand. Know this, the smart money never places their full positions at once. They break it into smaller pieces to avoid pushing the price away from their desired entry point. And that's where supply and demand zones come into play. These are the areas where the banks have initiated positions, causing sharp advances or declines in price. Demand zones are like magnets, attracting buyers and causing the price to bounce back up. They form when banks place a large number of buy positions, creating an imbalance that sends the price higher. Supply zones are pushing the price back down when banks unload a significant number of sell positions. So how do you spot these zones? You look for clues in the price action. You want to find sharp rises and declines, the footprints of the smart money. Look for big, bold candles with little to no wicks. These are the signs that the big players are making their move. To find demand zones, look for a fast upward move. Place a line at the high of the most recent red candle before the price increase, and another at the most recent swing low. For supply zones, look for a sharp decline, and place your lines at the low of the most recent green candle and the most recent swing high. In theory, when price revisits these areas, it has the potential to reverse. Now here's the catch. Not all zones are created equal. There are two golden rules you need to remember. Recent zones are far more powerful than old ones. The market is more likely to respond to zones that have been created recently. Second, supply and demand zones are one-time use only. Once the price hits a zone and reverses, it loses its power. The probability of another reversal at the same spot is much lower. There are four main types of price structures that create supply and demand zones. The rally-based rally is a demand zone that forms during an uptrend. It's like a pit stop for the price to catch its breath before continuing its upward momentum. First you'll see a rally, then a little consolidation, also known as the base, and finally another rally. On the flip side, we have the drop-based drop, which is a supply zone that forms during a downtrend. You'll see a drop, then a little consolidation, and finally another drop. This is also a continuation pattern. The drop-based rally forms a demand zone when the market decides to switch from falling to rising. You'll see a drop, a base, and then a rally. This creates your demand zone. We also have the rally-based drop, which forms a supply zone when the market decides to switch from rising to falling. You'll see a rally, a base, and then a drop, and this creates your supply zone. All these zones are like magnets for future price action. When the price revisits a demand zone, it's likely to bounce back up and continue its upward trend. When the price revisits a supply zone, it's likely to get rejected and continue its downward trend. So when the price approaches these zones, look for trading opportunities. Volume spread analysis is the ultimate weapon in day trading, the secret sauce that will help you understand imbalances between supply and demand. VSA has two main components, spread and volume. Spread is the difference between the opening and closing price of a candlestick. It's like the market's way of showing us how much ground it covered during a specific time period. A wide spread means there was a lot of price movement, while a narrow spread indicates less activity. Volume shows the number of transactions that occurred during that same time period. It's like the market's way of showing you how much effort was put into that price movement. High volume means there was a lot of participation, while low volume suggests a lack of interest. There are two main VSA concepts: sign of strength and sign of weakness. A sign of strength is when the market is showing you that the buyers are in control and demand is overpowering supply. This imbalance causes the market to rise. A sign of weakness is when the market is telling you that the sellers are in control and supply is overwhelming demand. This imbalance leads to a market decline. VSA goes hand in hand with the Wyckoff method. According to this theory, changes in market price are the result of effort versus result, volume versus price. If price action and volume are in sync, the trend is likely to continue. But if there's a significant difference between volume and price, the trend may be about to change direction. These are the top 5 sign of strength patterns. First up, we have the down thrust. This appears as a bullish pin bar or a doji candle with ultra high or above average volume. The spread is super low, but the volume is very high. VSA tells you that low spread should mean low volume, but when there's a mismatch, it's a sign that demand is overpowering supply, potentially causing price to rise in near future. Next, we have the selling climax. This one shows up as a high spread, bearish candle with a big downward rejection wick, accompanied by ultra high or above average volume. This signals that the market could rise because there is more demand than supply. We also have bearish effort lower than the bearish result. This pattern appears as a high spread bearish candle with a larger spread than the previous candle, but the volume is lower. It's like the sellers are trying to push prices down, but they just can't gain power. This disagreement between price and volume could lead to a bullish breakout. On the flip side, we have bearish effort higher than the bearish result. This one shows up as a low spread bearish candle with a smaller spread than the previous candle, but the volume is higher. It's like the sellers are pushing hard, but the price don't move much. This clash between volume and price could be a sign that the buyers are about to take over. We can also have the no supply bar. This pattern appears as a low spread bearish candle with a downward wick and lower volume than the previous 2 candles. It's like the sellers have just disappeared, leaving the buyers to run the show. When supply dries up, prices tend to rise. Sign of weakness patterns are the market's way of waving a red flag, warning you that the sellers might be ready to take control. First, we have the up thrust. This pattern appears as a bearish pin bar or doji candle with ultra high or above average volume. The spread is super low, but the volume is going crazy. When there's a mismatch between spread and volume, price has potential to fall in near future. Next, we have the buying climax. This one shows up as a high spread bullish candle with a big upward rejection wick, paired with ultra high or above average volume. When supply overpowers demand, it's time to watch out for a potential drop. Next, we have bullish effort lower than the bullish result. This pattern appears as a high spread bullish candle with a larger spread than the previous candle, but the volume is lower. If there's no effort, there shouldn't be a result. This disagreement between price and volume could be a sign that the market might decrease in the future. On the other hand, we have bullish effort higher than the bullish result. This one shows up as a low spread bullish candle with a smaller spread than the previous candle, but the volume is higher. When volume and price don't see eye to eye, price could fall in near future. We also have the no demand bar. This pattern appears as a low spread bullish candle with an upward wick and lower volume than the previous two candles. It's like the buyers have left the building, leaving the sellers to run the show. When demand dries up, prices tend to fall. Learn all these patterns because volume spread analysis is one of the most powerful day trading strategies. VWAP is one of the best day trading indicators. VWAP is a dynamic indicator that updates throughout the trading day, giving you a real-time view of where the price is trading in relation to its fair value. VWAP is like a magnet for price action. It acts as a dynamic support or resistance level, and price tends to gravitate towards it. When a market is trading above VWAP, buyers are in control. And when it's trading below it, the sellers are running the show. VWAP can also help you find potential entry and exit points. When a market is trading above VWAP and suddenly dips below it, it could be a sign that the buyers are losing steam and it's time to consider selling. Or when the price is trading below VWAP and suddenly pops above it, it could be a signal that the buyers are ready to take charge, and it might be the time to buy. VWAP can also help you with the strength of a trend. If price is consistently trading above it and making higher highs, it's a sign of a healthy uptrend. Another strategy is to use it in combination with candlestick patterns. If price is trading above the main line and you see a bullish candlestick pattern, like a candle with a long lower wick, it could be a sign to go long. Pivot points must be always present on your charts. These levels are like a cheat sheet for the market, telling you where the price is likely to find buying or selling pressure. Pivot points can act as a magnet for price action, just like VWAP. When a market is trading above the main pivot point, it's like the buyers are in control. And when it's trading below the main pivot point, the sellers are running the show. But pivot points aren't just about the main level. The other pivot levels can also provide potential entry and exit points. When price is trading near S1 or S2 level and suddenly bounces higher, it could be a sign that the buyers are ready to take charge. When price is trading around R1 or R2 level and suddenly drops lower, it could be a signal that the sellers are taking over and it's time to sell. A popular day trading strategy is to use these pivots as a guide for your entries and exits. If you see price trading near a pivot and you spot a bullish candlestick pattern or a VSA pattern, it could be a sign to go long. Never enter into a day trading position without seeing confluence. This is when multiple factors and signals come together at the same point in the market. You want to find setups that have the same price signal from multiple methodologies. Supply and demand zones, volume, pivots, all of these factors will offer you signals. When some of these tools start lining up at the same location on your chart, you found a confluence area. Let's say you spot a bullish VSA pattern right near a daily pivot point. If the VWAP is also close, that's a confluence, a time to consider a buying position. Or you find a supply zone that aligns with a pivot point. If price momentum confirms that zone, you now have a sell opportunity. After over 15 years of experience, these are my best day trading tips for beginners. First, use a small account or even a demo account in your first 6 months to practice and build your skills. Second, manage your risk like your life depends on it. Always use stop losses to protect your downside, and don't let a single trade wipe you out. Also, losses are inevitable in day trading. You accept them and move on. And you don't try to get back your money after a losing trade. Also, keep your charts clean and simple. Less is often more when it comes to day trading. And accept the fact you won't become an expert day trader overnight. You need lots of market exposure. The more exposure you have to different markets and setups, the better you'll become at pattern recognition. If this day trading guide helped you, make sure you don't miss out on our next videos.